So it's your first time. Don't worry, we're going to make it a good one. On this week's Emily Now episode, we're talking about first-time home buyers. What do you need to watch out for when you're purchasing your first home? What do you need to know about interest rates? And we're going to walk you through some first-time home buyer disasters that hopefully you can avoid, and we'll wrap it up with talking about this crazy Canadian real estate market and what that means for you if you're buying your first home. So stay tuned. My name is Dylan Gallagher, founder of mlenow.ca. I've been helping people and businesses for the past 18 years get the mortgage or loan that they need so that they can do more. We put this weekly Emily Now episode together to teach you a little bit more about all things finance with a focus on mortgages and loans and sort of all things debt, because we believe that if we can help you navigate some of these issues that you'll be able to make better decisions, and that those better decisions will lead you to save money for the future, maybe take advantage of new opportunities, or who knows, maybe with all of your newfound wealth you'll give back to the community around you. You can follow us on Twitter at mlenow.ca. You can like us on Facebook, subscribe to us on YouTube, +1 us on Google, and send us your questions. Chat with us. We post lots of content throughout the week on various topics and various issues, and would love your feedback. Would love your questions. And with every episode, we include a couple of questions for you so that you can, probably questions that are either on your mind or certainly on the mind of those that are following us. The first question this week is, what do I need to watch out for when purchasing my first home? I mean, that's a pretty broad question, but for those of you that have never bought a home before, have never gotten a mortgage before, this is a question that people don't ask directly, but they seem to ask indirectly. And so to help you with your first time home buying experience, make sure it's a good one, here's some things we think that you need to watch out for. One of the big ones that most first-time home buyers wouldn't be aware of is making sure that the property you are purchasing is worth what you're paying for it. And so what do we mean by that? Well, if you see a property that you really like, and maybe it's $350,000, and you work out all of your math and your down payment, and you're very excited, you want to go and make an offer, and then it turns out that you get an appraisal on the property, and it turns out the property's worth $300,000, not $350,000. Well, the reason that's a problem for you is because the bank is only going to lend to you based on the lower of either the purchase price or the appraised value. So if you work out, 10% of $350,000 versus 10% of $300,000, that number is different. But not only is it different, if you buy a house that you made an offer for at $350,000, the appraisal comes in at $300,000, you're going to actually have to come up with that other $50,000 difference plus your down payment on the actual appraised value of $300,000. So if you're working with a good real estate agent, this rarely ever happens because they have a very good sense of what property values are, and if they're not sure, they're going to make sure to include a clause in the purchase agreement that says, look, we're going to need an appraisal done on this property, so we want to make sure that we can get access to the property. But if you're going it yourself, if you're going on some of the self-serve websites, or maybe you're doing a private sale of some sort, or even if you are using a real estate agent, one of the things that you need to know about is that the property you are buying is actually worth what you're paying for it. Another big thing to know is that you should know your numbers before you go out with your real estate agent. And many people, it's springtime or it's summertime, or an event happens in their life and they think, what, we want to go out and buy a property, and they don't kind of figure out how much cash they have, or if they do, they just sort of do it on the back of a napkin and say, what, we've got $50,000 or $30,000, or we can get a gift from our parents to buy a home, but they don't really work out, do we have enough income for the mortgage? Do we have the credit score that we need in order to get the interest rate that we want? And so they end up going out with a real estate agent. Real estate agents don't have a really great way of asking you, hey, have you checked out your math? Do you know if this is something that you can afford? And so you might end up making an offer on a property, or spending an enormous amount of time looking at properties and making offers and spending a lot of time with your real estate agent, only to find out that you're not even close. that you didn't work out your numbers and you make an offer and you go to get an approval using mlenow.ca or using a mortgage broker, specialist, or a bank, and it turns out you don't qualify. Well, it's kind of a problem. And so as a service to yourself, as a service to the people who have listed their home that you might be looking at making an offer on, make sure that you know your numbers before you go ahead and do that. Another thing to keep in mind is to make sure that all of your information is in order before applying for a mortgage. And if you don't have your job letter, if you don't have a pay stub, if you don't know where your bank statements are, if you don't have a copy of your credit report, you might find yourself in a situation where you find a really great property, a really great price, but you have to close quickly in order to get the good price. And so all of that seems to be okay, and then you can't find your tax return, or it turns out that your employer doesn't give you the job letter on time, and because you didn't have all of your stuff together, trying to close a deal quickly, it doesn't close on time, and so then you're going to be charged late interest. You're going to have a vendor who's very upset with you. Your real estate agents are going to be going bananas because you simply didn't have your stuff together. And so you can figure out what that stuff is at mlenow.ca, but the point is some of the things you need to know about buying your first home is make sure you've got this information together before you go ahead and make an offer so that you've left yourself enough time to deal with it. And then, kind of the last big one is make sure that you've sorted out your down payment before you make an offer. And why that's important is because some people think, oh, we've got $10,000 or $20,000 or $30,000 to put down, but it turns out we have to pay off our MasterCard before the bank will approve us. So now some of that money that we had as a down payment, turns out we're going to have to use it for the credit card, and now we're short on our down payment. So maybe you need a cosigner. Well, trying to find a cosigner after you've made an offer can be pretty tricky. Maybe mom or dad don't want to sign for you, or maybe somebody in your family doesn't want to co-sign the mortgage, and now you just find yourself in a bit of a jam. So make sure you've worked out your down payment options, which sort of relates back to the other things that I've mentioned, which is being prepared, having your information together, and having your down payment rather sorted out. Is very important. And so if you're interested in getting prepared for your first mortgage, we'd encourage you to visit mlenow.ca and get an Emily score. You might be asking, well, what is an Emily score? Well, an Emily score tells you how prepared you are to be approved, and the Emily score can be used to determine the interest rates you're going to receive. It's used to help you understand which banks or lenders will approve you. In fact, you can see them all right there inside of your account. And we also have an amazing client services team that will take your Emily score, maybe it's a 5 out of 10 or a 4 out of 10, and we're going to try to help you get all the way to a 10 out of 10 so that you've got all of the options available in the marketplace. It's free. It doesn't cost anything, and if you're looking at buying your first home, we'd encourage you to get started today. Our second question is sort of a big blanket question, and it is, what do I need to know about interest rates? We hear about interest rates, you see interest rates being advertised everywhere, and it can be difficult to understand, what's the difference between, that rate at 2.9 and that rate at 2.89 and that rate at 2.6. And so what I always say is that kind of the first thing you need to know about interest rates is that you may never ever know if you actually received the very, very best interest rate that's out there, because each bank offers interest rates that are competitive with each other. Some are higher, some are lower, but there's so many other things that can change the interest rate. Mortgage brokers, mortgage specialists can use their commission to buy down an interest rate, and today, because of the competitiveness of the residential mortgage market, that seems to be happening more and more and more. And so it adds, obviously confusion for you as the first-time home buyer trying to understand, well, what is the best interest rate? And if you look around the internet and kind of check out different banks and brokers, you might find that it's a little bit exhausting in terms of understanding, like, what is the best rate that I'm getting. And so we try to compare it to buying a car. If you took a Ford F-150, you'll find that prices are generally the same across the market. Different dealerships will offer you, though, different specials or different bonuses to encourage you to buy the Ford F-150 from their shop. It's no different than the bank. In fact, if you paid attention to the news, banks are using the same taglines as car dealerships, like employee pricing. Banks are also going to offer you different specials or bonuses You don't want any prepayment privileges? No problem, we'll give you a lower rate. You want to be able to pay your mortgage down quickly? Okay, well maybe the rate will be a little bit higher. Do you need to go to a bank branch, or are you okay using a bank you've never heard of? Okay, no problem, that'll lower the rate. Oh, but are you closing in the next 30 days? Because if you are, we can get you a better rate than if you were closing in 90 days. So all of these things can be very, very confusing. Each bank kind of has a certain type of client that they want. Are you self-employed? Have you been employed forever? Are you a real estate investor buying rental properties, etc.? Each of the banks, they all have kind of a customer that they want, and so they structure and price their interest rates accordingly. And our advice to you, the first-time homebuyer in particular, is just to get a good sense of where interest rates are. Kind of know what the 5-year closed rate is, know what the 5-year variable rate is, kind of have an understanding of some of the other interest rates so that when you get an interest rate, you can kind of, it hopefully would check out and make sense to you. But like anything, you've got to do your homework. We can help you with that. Simply visit mlenow.ca, register for an account. You can get some very basic information on interest rates and the interest rates that you'd be eligible for based on what we call an Emily score. You can send your request directly to the banks that match your Emily score. And your Emily score tells you, of course, how prepared you are to be approved, and then it also tells you which banks or lenders are even going to look at your deal. And so there's no cost to you for using mlenow.ca, and our team, of course, would be happy to help you. It's not just a website and a platform, but there's real human beings behind it. We have live chat, we have email, we have telephones. I think we got a fax machine kicking around somewhere, but we can certainly help you. So hopefully that helps you understand some of the things that you need to know about interest rates in general, and if you're a first-time home buyer, even more so. Do your homework, get a sense of where the interest rates are so that as you go out into the market and talk to brokers, banks, and specialists, mlenow.ca, that you've got a pretty good sense of whether or not you're getting a good deal. First-time homebuyer disasters. Normally at this point in an Emily episode, we take one specific client example and walk you through it. But for first-time homebuyers, there just seems to be so many of them that I thought it would be better maybe to categorize them or give you, kind of 3 or 4 broad examples of homebuyer disasters so that you can avoid them or at least be prepared for them if they do happen. Keep in mind, I've been doing this for a very long time. Folks here have been doing it for a very long time as well. And over 18 years, I've seen tons of disasters, and kind of here are some of the common ones. Losing a job before the closing date. You get approved, you tell the bank you make, this is the kind of job that you have, this is how much money that you make, and then all of a sudden the bank says, okay, great, well, we're gonna call your employer, we're gonna verify this information, only to turn out that you've lost your job. You made an offer on a home, you've removed conditions, in fact the mortgage was moving all the way down to the law office, and then at the 11th hour you've lost your job and now you don't have enough income to qualify for the mortgage. It's a pretty big first-time homebuyer disaster. That's a pretty big disaster on any deal, not just first-time homebuyers. If we're talking about income, one of the disasters is that the income you put on your application is not the income that your employer says that you make, and some people don't really appreciate how significant this is. You might make a base salary plus some bonuses every year, and so in your mind, the amount of money that you make is the amount of income plus the bonuses from last year. A bank will look at that though and say, well, we only want to know what you get paid every 2 weeks. Your bonuses can be high, they can be low, and so if you want us to include your bonus income, we're going to need to look at the last couple of years of tax returns and average it out. Well, a disaster comes from you make an offer, you think you're approved, and all of a sudden you throw in your pay stubs and some tax returns and the bank goes, oh wow, you don't make that much money. You don't make as much money as you told us you made, and so therefore we're gonna bump it down, and guess what that means? We're gonna lower the mortgage amount. So that means you've got to come up with more down payment if you still want to do the deal. Kind of a bit of a disaster. The appraisal is less than the purchase price. That's always a real bummer when that happens. Somebody buys a property, everyone believes the property is worth what the offer was made for, and then the lender comes along and says, look, we'd like to do an appraisal on the property. The appraisal comes through and poof, it shows that the property is not worth what you're paying for it. The reason that's a disaster is because now If you made an offer to buy a property at $350 and it's worth $300,000, as far as the bank's concerned, they're only lending you money based on $300,000. You're going to have to come up with the other $50 plus the normal percentage down payment that you were going to put down in the first place. So that's a huge disaster. But the big one that we find, which there's no really way to get around it because it just sort of happens, but when credit scores drop, you may have made an offer on a property 2 months ago, and it's scheduled to close maybe next month. And in the meantime, you've had a collection show up on your credit bureau, or you've missed some, the last 2 payments on your credit cards because maybe you're starting to buy stuff for the house, but you didn't make your payments. Well, every bank and lender will check your credit before they advance funds. And so if your credit score was, 690, and then all of a sudden they do a credit check and it's 620, you might find that bank says, you know what, we're no longer interested in giving you a mortgage, so we're going to decline and close your file. You're going to need to go somewhere else. That's a bit of a disaster, and that's a pretty big problem. So make sure that if you have made an offer on a property, that you're not doing anything with your credit until you've closed on the property. And even if you've closed on the property, it's still really important to keep your credit score high, make your payments, and keep that in check. So you can avoid some first-time home buying disasters by creating an account at mlenow.ca, getting an Emily score, see what you need in order to be approved, see what credit score you need, see what documents you need, see what the interest rates are going to be, how much income you have to make sure you have, and keep in mind that we're here to help you structure your deal as well. So if you have some questions, or if you're not really quite sure, or you've heard some of these disasters and you're going, oh, I want to make sure I don't get caught in that, you can talk to our service team, and they're really great at what they do, and they'd be happy to help you. So anyway, avoid those disasters, in particular if you're a first-time home buyer who's never done this before. Hopefully this has given you a little bit of insight into some things that you don't want to find, some situations you don't want to find yourself in. Let's talk about what the heck is going on with this crazy Canadian real estate marketplace. There was an article in the Financial Post that talks about, some markets being hot, red hot, I think was the term that they used, and some being cold. You've got the Toronto, Ottawa, Calgary, they're all way up and doing really, really well. And then in Edmonton, Regina, and Saskatoon, there's a whole bunch of construction projects that are finishing, that are bringing new inventory into the market, which is pushing prices down a little bit. But what does this mean? And in particular, because of today's Emily episode, what does this mean for the first-time home buyer? So prices are high, so generally that just means your down payment's going to have to be higher, or you're going to have to make sure you have enough down payment. But the offset to having more down payment and paying a higher price for your house, of course, is that interest rates continue to be incredibly low. I mean, in my mind, because I've been doing this for so long, this is pretty much free money, and it's been free money for like 10 years, pretty much. But part of the risk of being a first-time home buyer today is that if you purchase a property and the value doesn't hold in the next 10 years, so say, over the lifetime of the real estate market, prices generally go up. But the point in time we might be at right now is where you're buying at the very, very top of the market, and we might see that the market comes off for the next decade, and then it starts to come up again. The interest rates, of course, could have a downward pressure on house prices, and in particular, where the supply of homes is plentiful, where there's lots of inventory. If interest rates start to go up, then those prices are going to have to come down in order to have those houses move in the market. But it doesn't appear that kind of in the major centers in Canada that's going to happen anytime soon. Yeah. Make sure you have a long-term view if you're a first-time homebuyer, because that whole idea that maybe you are purchasing at the very top of the market, maybe your house price doesn't rise, but maybe it doesn't fall. You might find that after you've made 5 years or 10 years worth of mortgage payments, that really you just paid a ton of interest and your house didn't kind of rise above the cost of what that mortgage was. And so that's part of your risk. But you can hedge some of this stuff. You can have a plan. And part of that plan would include two big things: either paying down your mortgage to the best of your ability every year. I mean, if it's a $500 or $1,000 or $10,000, take advantage of those prepayment privileges to chop that principal balance down quickly. And if you can't do the lump sum principal payment, then make sure that you're doubling up your payments. You can at any time. Most banks will let you call them and say, look, I'd like to increase my payment by 20% or 25%. And that increase goes directly to principal, which of course helps you pay off the balance quicker. Like everything in this crazy Canadian real estate market, do your homework. Understand the prices of homes. Understand where they need to be for you to at least keep your investment at par. And while no one can predict the future, certainly there's enough information out there to help you understand, well, where does my house have to be in the next 10 years if I'm going to not only recover the interest that I've paid, but also realize a little bit on my investment. And so do your homework, understand your costs. And another big one for those of you that are employed is to understand how confident are you about your employment prospects over the next 10 years. If you think you're going to continue to have be employable and earn the same level of income that you earn today, then that's something to take into consideration when you buy your home. If you're not so convinced that your job prospects are going to be really, really great, then maybe today's not the best time to buy your home if you think that real estate prices might come down, because if you lose your job and then you have to sell your house, but you can't sell it for the amount of the mortgage, then it's going to be a very long time till you buy a house again. And so that's something to keep in mind. Another thing to consider is, can you find a way to budget your expenses so that you can make principal payments against your balance? Most first-time home buyers at the beginning of their career or their life with their partner, everyone kind of has their separate bank accounts and everyone just sort of spends their money. But budgeting can be really, really tough. In fact, it can take years to get a good budget put together. But if you bought your home, that's usually a pretty good time to look at your expenses and say, hey, how can we save $500 a month, or how can we save $200 a month, and take that money and apply it against our mortgage at the end of the year. So that's something to consider. Take some time to know your options. At mlenow.ca, we've built a platform where you can do exactly that. It's a pretty innovative and disruptive idea. It's meant to show you what based on your information, some simple information from you, kind of how you score out of 10, and based on that score out of 10, you can see what interest rates you would qualify for. You can see the banks or lenders that would be eligible for your request, and then you can send your request to our client services team, who'd be happy to help you. You can send your request directly to the bank, and we'll help you facilitate that so that you can just do more and not waste your time with applications and meetings and trying to find time in your schedule to go sit with a mortgage specialist. You can do it all from the convenience of your computer, and so we'd encourage you to do that. Thank you for watching this week's Emily Now episode, and we look forward to seeing you next time.